Good afternoon, everyone. Thanks for taking the time to join us today. My name is Kyle Irish, and I'll be hosting today's webinar. Today, I'm joined by Rademeyer Vermaak, Head of Portfolio Manager for the Standard Enhanced Multi-Style Equity Fund, as well as Vanessa Mathebula, who is a quant analyst within the Standard Index Investments franchise. But before I hand over to them, just some housekeeping. CPD points will be allocated to you should you remain logged in for the full duration. So please stay throughout the webinar. And secondly, please submit your questions during the webinar via the Q&A button. The chat functionality has been disabled. So unfortunately, anything that comes through there, we won't receive. So looking back at 2021, this was the first time in about 3 years we saw the CISA general equity sector ending with positive flows to the tune of around 9 billion. We also saw a significant rotation of style where value outperformed growth, which meant a large portion of the inflows in the sector went into value funds relative to prior years. Before this and before COVID, the trend was completely the opposite, as growth was outperforming and taking the majority of the flows. As we have seen, however, it is not always easy to predict when these style rotations happen, and they can be short and sharp or prolonged. The Standard Enhanced Multi-Style Equity Fund looks at each stock through a lens of 3 factors, namely growth, quality, and value, in order to provide a fund which is style agnostic and able to deliver consistent benchmark beating returns through various rotations. As this is a systematic active equity fund, it is also able to deliver these returns at a very low cost over time. So without further ado, let me hand over to Rademeyer and Vanessa. They will provide further insight into the fund and the process through which the portfolio is constructed, as well as a masterclass on how to view any fund through a different lens as if it were a stock. Thanks, Rademeyer and Vanessa. Over to you.
Thank you very much, Carl, and good afternoon to everyone who's joined us for this webinar. Certainly very excited to take you through the fund and the masterclass. Let me just share my screen here. So in essence, really, what we want to talk to you today is talk to you about the Standard Enhanced Multi-Style Fund as a fund designed to give you long-term capital growth. Talk you through about how it works and also tell you about why we think it can keep on delivering the outcomes it has thus far. So the agenda is to first give you an introduction, then a quick primer on active fund management, after which I'll hand over to Vanessa, who will take us through the masterclass of how to view a portfolio as a stock. Then we'll use that lens to look at Standard Enhanced Multi-Style Fund and see how it compares to the benchmark in terms of this new lens. We'll then look at how to combine the fund with other funds and conclude with a couple of key takeaways. So the essential question really is, if you could get an active equity fund with no style bias, top quartile performance, and at a fraction of the cost, would you buy it? If the process was transparent and well articulated with no style bias, if it had persistent alpha generation and that also had a low correlation to competitors, with an effective bottom-up stock selection process and an established team with an established track record behind it. And that is exactly what the Standard Enhanced Multi-Style Fund has delivered. Looking at performance of the fund over the last 5 years, over a number of various periods, you'll see that year to date, as at the end of April, the fund has outperformed the benchmark, which is the CAP Swix, by 3.67%, over a 1-year period, 5.1%, and then an annualized outperformance over 3 years of 2.5 and over 5 years at 4.3%. So it really has done what it says on the tin, and we will elaborate on why we think this is sustainable and why we think the outperformance can continue. What this chart here shows us is the performance of the fund in the Morningstar General Equity category on the left. So it takes all the funds in the Morningstar General Equity category, it ranks them, and you'll see that the Standard Enhanced Multi-Style Fund sits in position number 17, so comfortably in the top quartile in terms of performance. We select 2 other funds on various, one slight outperformer, one slight underperformer, relative to the standard enhanced multi-style fund in terms of performance. As importantly to us, if we look at the chart on the right, which shows the net expense ratio, you'll see that the standard enhanced multi-style fund is easily in the bottom quartile, almost the bottom 10% in terms of net expense ratio, making it one of the lowest cost, most cost-effective funds in the SA market. Basically, the funds to the right of it are almost all index trackers. And an important point to drive this home is the positioning of these two competitive funds, one with slightly better performance and one with slightly worse performance in terms of their expense ratio. So really getting a lot of bang for your buck in terms of active share and alpha at a very cost-effective price with the standard enhanced multi-style fund. On this slide, we've done a slight comparison of a one-year rolling alpha through time and to show the consistency of the alpha of the standard enhanced multi-style fund. But I think the real message on this slide is the correlation of the alpha streams of the standard enhanced multi-style fund when you blend it or when you compare it to a couple of the traditional fundamental equity, active equity funds in the market. So important to elaborate, to make the point that this fund is an active equity fund, very active. It merely uses a systematic process. And I think the other important thing in terms of when you analyze correlations and to combine funds is to look at the correlations of alpha. What we typically see is that a correlation analysis is done on the entire fund returns. And because the market beta is still then in the returns for every fund, you tend to see that the alpha or the correlations between different funds is very high. If you, however, subtract the benchmark or the market return, you only look at the alpha, then you really start to see the benefits of combining different funds in terms of the correlations. So the correlation of the standard enhanced multi-style fund ranges from a moderate 0.4 versus one competitor to almost zero and slightly and to strongly negative with a number of other competitors. So a fund that certainly combines and could potentially blend very well with an existing selection of managers and at the same time bring down the cost on your fund fact sheet. I'm going to give you a slight sneak peek as to why we believe the fund has performed as well as it does and what Vanessa will be talking about. And it really is the positioning of the fund along three dimensions. So by very deliberately picking stocks with certain characteristics, we are able to construct a portfolio and a fund that has got a higher return on equity than the benchmark. So the portfolio's return on equity is 24%, whereas the benchmark is at 18%. In terms of earnings quality, that's a measure of the amount of cash flow that a company generates. How much of its earnings is cash versus how much of the earnings is accrued. And you'll see that because of our preference for companies that are cash generative in its earnings, we've got a much higher earnings quality in the standard enhanced multi-style fund. So in the quality dimension, we've built a portfolio that is of higher quality than the benchmark. If you look at the growth dimensions, you'll see that the earnings growth over the last year of the standard enhanced multi-style fund is a lot higher than the benchmark. And on a forward-looking basis, in terms of earnings revisions for the stocks in the portfolio, the benchmark has only got 1.66% of earnings revisions, whereas the portfolio has got 2.89. So in the growth dimension, we've managed to construct a portfolio that is of higher quality than the benchmark and has got better growth drivers and growth dimensions. Now, the final nail in the coffin really is if you look at the valuations. Despite the better quality than the benchmark and the higher growth, the fund has actually got a lower 12-month PE ratio than the benchmark and a higher trading 12-month dividend yield. So even in the valuation department or dimension, the fund is cheaper than the benchmark. And if we can keep on constructing a portfolio that is better than the benchmark in these dimensions, we believe that it will result in time in persistent outperformance. So let's quickly think about what active fund management really is. And active fund management is an investment strategy where one seeks to generate alpha or outperforming the benchmark by altering the holdings in the portfolio through buying and selling based on information. Now, successful active investment enables one to achieve returns that beat the benchmark and to manage risks. So how do traditional discretionary fund managers pick stocks? They look at the information from the financial statements, such as the balance sheet, the income statement, and the cash flow statement. And then they perform a number of analysis on that. So these are, for example, the discounted cash flow analysis, perform an analysis on the growth of earnings, the forecast of that, the valuation of the forward earnings, and also a number of qualitative analysis methods, such as determining the quality of the management team, and to a large extent, intuition. And we find that typically traditional discretionary active managers invest according to a very specific style. So you'll find a value manager or a quality manager or a growth manager. What I want to point out here is that we use exactly the same information, and you'll see that sprinkled throughout the presentation, but we implement that information very systematically using our cutting edge process. So with that, oh, apologies, one more slide. The reason why we divide the dimensions that we measure the fund up along into quality, value, and growth is actually quite intuitive. When we talk about the growth of a stock, what we mean is the top line of the company. So the sales line. How big is the sales line for the company, and what is the opportunity set for the company to grow its sales? That we measure holistically, and we combine that into a measure for growth. The second dimension of quality really speaks to how well the company is able to translate the top line to the bottom line. So sales into earnings, and it speaks to the profitability of the company, the business model, and company management. And we holistically group that in a dimension called quality. And then we look at valuation metrics to try and buy these companies that have got growth opportunities and able to be drive a high return on equity and high return on invested capital at decent valuations. And that really is the recipe that we think is the answer to sustainable alpha in terms of active investing. So with that, let me hand over to Vanessa for a masterclass on how to view a portfolio as a stock. Thank you, Vanessa.
Thank you, Rademeyer. So one of the points Rademeyer noted is the various investment styles that we invest in. On the screen, you see an example of the metrics we typically consider in each investment style. So for instance, quality is proxied by return on equity, and this speaks to the profitability of the given company. From an analytical perspective, or an interpretations perspective, the higher the value of ROE, the better. When it comes to value, it is proxied by forward 12 months price earnings. And here we are interested in how cheap the given company is. And here, the lower the value, the better. Finally, we see that growth is proxied by earnings growth over 1 year, which is pretty self-explanatory. And the higher the value of this metric, the better. So if we were to consider Naspers from an investment perspective, what clearly stands out is its negative value for quality. So if we're, for instance, to invest solely from a quality perspective, we would most probably exclude Naspers from our investments if we're just looking at one stock. And when it comes to value and growth, we do see that these values are positive and high. However, it does still seem a bit of a challenge to make an investment decision by just looking at one stock. And this is because the best way to view an investment proposition is to, for instance, take a stock and see how it relates to a bucket of other stocks. And this is the core basis of portfolio diversification. So in simple terms, portfolio diversification allows one to get a better return profile by investing within a bucket of stocks as opposed to investing in one stock. And this just highlights the risk the risk benefits of portfolio diversification. So you can see that we've taken Nespers and added 9 stocks to create a basket of 10 stocks. And the idea here is to create a portfolio and see if we were to view this portfolio as a stock, how does it compare on the various metrics to the stocks within the basket? Because ideally, if the benefits of diversification do in fact exist, the portfolio metric should ideally be better. So let's see how we would go about getting the various metrics at a portfolio level. Starting off with ROE. Next slide, please. Starting off with ROE, and as you can see, this is an Excel example. So on Excel, we would use the sum product function, and we would take the sum product of the weight column and the given metric. And since this is an equally weighted portfolio, you can see that we view each stock equally because each stock is given 10% within the basket. And then we end up with the ROE value for the portfolio. Next step is to calculate the value metric for the portfolio. And again, we use the same formula and we take the weight column and the metric column and end up with a value for 12 months PE that accounts to 12.73. And before we move on, what stands out, if you were to just look at the portfolio metric for quality and value, what clearly stands out is that from a majority of these stocks, the portfolio value is better. And this just briefly highlights the benefit of diversification within the portfolio, even though this portfolio is equally weighted. Finally, we move on to growth and follow the same process and end up with the growth value for the portfolio that is equal to 25.91. So another aspect of portfolio diversification is the importance of portfolio construction. And this speaks to the fact that if we were to optimize the weights and allocate the weights for each stock based on how important the stock is within the bucket, we should ideally better than a single stock and better than the profile of an equally weighted portfolio. As you can see, next slide, please. As you can see, if we were to compare the output for each metric that we got from an equally weighted portfolio to the portfolio where we optimize the weights, we can see that across board, the scenario weights portfolio is superior. Now, on a more practical footing, let's take a look at the Standard Enhanced Multi-Style Equity Fund and see how it performs if we're to look at it as a stock, but more importantly, how does it compare as well in relation to its benchmark? To kick off the analysis, we're going to start off with the benchmark, which is the FTSE JSE Cap Swiss All Share Index. And you can see the index itself has 145 constituents. And as you can see on the weight column, we have a total of 100, which is the core characteristics of each portfolio. Now, the next thing is to conduct the same analysis that we did previously for the scenario portfolios for this benchmark and to see how the benchmark performs if we were to view it as a stock. And as you can see, the line at the bottom gives us the benchmark metrics for the various, the benchmark values for the various metrics. By just looking at the benchmark by itself, we can't really make a lot from the numbers. So what we need to do now is to look at how the Stanley Enhanced Multi-Style performs and then compare the two. And to kick that off, we can see the constituents of the Stanley Enhanced Multi-Style Equity Fund. And one thing to note here is that, as noted before in the slide for the benchmark, the constituents totaled 145. But for the Stanley Enhanced Multi-Style Equity Fund, the constituents total 34. And this highlights the high active share of the Stanley Enhanced Multi-Style Equity Fund. So on the next slide, we then do the same analysis with the idea of viewing the portfolio as a stock and ideally getting the metric for each, the metric for the portfolio, so as we can compare to the benchmark. Apologies for that benchmark at the bottom, it's supposed to be portfolio, but I can confirm that the metrics are correct. So as you can see, we've managed to get the metrics for the benchmark and for the Stanley Multi-Style, and we can now compare and see, does the Stanley Enhanced Multi-Style Equity Fund perform better than the benchmark? And what stands out is that from a quality perspective, we do see that the Enhanced Multi-Style Equity Fund has a higher ROE. From a value perspective, we can see that the Stanley Enhanced Multi-Style Equity Fund has a lower PE. And as I mentioned before, from a PE perspective, we are looking for a lower value. So this is good. Finally, we can see that from a growth perspective, we do have a higher growth number. I will now hand over to Rademeyer, but before I do that, one point to note is that the metrics I have just analyzed for the Stanley Enhanced Multi-Style are just a glimpse at what we look at. In fact, we look at various metrics so that we can have a more holistic view of the performance of the fund across the various investment styles. Thank you. I'll now hand over to Rademeyer for the third part of the presentation.
Okay, thank you so much, Vanessa. So I think Vanessa touched on the point that the ROE for 12-month PE and one-year earnings growth numbers are merely indicative of the holistic perspective we form for every company along each of those dimensions of quality, value, and growth when we evaluate a stock to decide whether it's a stock that we want to include in the portfolio or not, and whether it would add value in terms of the characteristics of the portfolio or not. So to maybe just go a little bit deeper into a bit more detail in terms of the holistic dimensions we look at when we evaluate every stock and therefore build the portfolio. I think we've covered return on equity quite deeply in Vanessa's masterclass, but maybe just a little bit, pausing a little bit on earnings quality. Now, what earnings quality really comes down to is how much of a company's earnings is accrued versus how much of a company's earnings is actual cash. And we prefer companies that generate cash and therefore companies with a higher earnings quality. And you'll see that we've managed to construct a portfolio to have a higher earnings quality than the benchmark. Vanessa has already eloquently covered the forward 12-month PE and how the fund is cheaper than the benchmark on a forward 12-month PE ratio. But equally, interestingly, even on a trailing 12-month dividend yield, the fund has got a higher dividend yield than the benchmark. So in the value dimension, the fund is cheaper than the benchmark. And then in the growth dimension, we've covered earnings growth, but let's look forward over the forward 12-month earnings revisions over the last quarter, and you'll see that the fund has got significantly and persistently higher earnings revisions than the benchmark. So in the growth dimension, the fund has got better growth characteristics than the benchmark. So I think that's what Vanessa means when she talks about performance. It's not necessarily the performance in terms of returns, but the characteristics of the fund if you view it as a stock. Let's now build this example from the ground up and start with a simple stock example. Exxaro is one of our favorite stocks in the portfolio. So let's look at the fundamentals of Exxaro. And you'll see it has got dimensions in terms of quality, those metrics we measured. Dividend yield for 12-month PE of 3.85. It's got a price to book ratio of 2. Analyst revisions forecast an earnings growth of 4.42%, and the 5-year growth rate is 26.34%. So, we see the different metrics for Exxaro from a fundamental and balance sheet and income statement perspective. Now, the question is this good or bad? Do we want to own Exxaro or not? And how does it compare to the other stocks in the SA market today to decide whether we want to buy Exxaro and hold it or not? And in order to facilitate that evaluation process, what we do is we construct a holistic score for every stock for Exxaro along the 3 dimensions of value, quality, and growth. And that's what you see here in this top bar. Now, to give some perspective, this number is a number that can vary between -3 and 3. For the more technically minded, it's a Z-score. And what that means is a number of 0 is in the middle of the pack. It's average. So if a stock has a value, a Z-score of 0, it's very average. It's neither cheap nor expensive. And you'll see that Exxaro scores very highly in the value dimension. So it is a relatively cheap stock. It's actually a very cheap stock compared to the other stocks in the market on this holistic value dimension that we evaluate. It's got slightly better than average quality at 0.32, and it's got significantly higher than average growth. If you now look at the sum of these 3 metrics together, you get what we call the alpha signal, the potential for Exxaro to outperform the market. And this stock really ticks all the boxes in terms of quality, value, and growth. And that is why on this chart here at the bottom, it shows Exxaro in light blue as our favorite stock. The other stocks in the market are indicated in gray, and the green bars are the stocks in the same sector. So the holistic perspective on Exxaro is the blue bar, and it's a stock that we like. This time series here shows us how this blue bar has evolved through time, from a position of 0 at points in time where it was middle of the pack and we didn't have a particularly strong view in Exxaro, to how it's evolved into becoming one of our favorite stocks at the moment. Now, being able to have an accurate prediction for alpha is a very important dimension in active fund management. The other important dimension in active fund management is risk. The ability to manage risk depends on the ability to measure risk. And that is really where a systematic investment process that is data-driven and evidence-based really comes into its own. And I'll give you an example of that for Exxaro. These are some of the risk dimensions that we take into account when we construct a portfolio and when we evaluate the scale of alpha or potential versus risk or downside. And for every single stock in the market, we evaluate the risk along a number of dimensions. We look at the rand-dollar exchange rate risk. We look at the gold risk, gold exposure for the stock, and the oil exposure for the stock. Now, perhaps not so excitingly for Exxaro, it doesn't have any exposure to any of those 3 macroeconomic return drivers. So perhaps not a very exciting result in that regard, but it becomes important when we start to construct the portfolio. The other risk dimension that we look at is the average correlation of Exxaro with every other stock in the market. And what that speaks to is the ability for us to build a diversified portfolio. Now, this is classic finance 101. If you construct a portfolio of uncorrelated stocks, you're able to maximize the alpha and minimize the risk. And that is what we see here for Exxaro. If you combine Exxaro in a portfolio with the black stocks, so BHP and Anglo American, you're not really getting any diversification benefits. However, combining Exxaro with an Anheuser-Busch or a British American Tobacco certainly gives you a lot more bang for your buck in terms of additional alpha and a reduction in risk. Now, the way we then construct the portfolio is to take the alpha signal for every one of these stocks and all the risks, and we put that into an optimizer. And we tell the optimizer, give us the optimal portfolio with the maximum amount of alpha and the minimum amount of risk. And we constrain the optimizer along a couple of dimensions. So we say we don't want to take more than 5% active single stock risk, etc. And we get back the optimal holding for Exaro in our portfolio, given its alpha and given its risk dimensions. And that's what we see here on this chart. So the top bar shows us the share price performance for Exaro over the last 20 odd years. And the bottom chart shows us how we've positioned the fund from an active weight perspective relative to benchmark in Exaro. And you'll see that we started to build our overweight position in Exaro sort of early 2017, and we've managed to capture a large part of that bull market as a result. So I think that hopefully gives a bit of perspective in terms of how we construct our portfolio. But I think it would be interesting to go through a couple of other examples, perhaps on the stocks that we don't like. Naspers is an example of a stock that we don't like. It is in fact our least preferred stock, and we've been persistently underweight Naspers for a very long time, and it has served us well over the last couple of months. If we look at those same metrics for Naspers, you'll see that we find Naspers expensive from a value perspective, so it scores negatively. It doesn't have a good quality score, so it doesn't convert a lot of its earnings into cash. It doesn't have a high profitability, and growth has been negative in terms of the holistic growth dimension that we built for Naspers. The results of that is we find Naspers at the bottom of the pack as our least favorite stock. Excuse me, I think what's, let me go to Glencore, which I think would highlight the other dimension of why risk management is so important. So for Glencore, we like it because it's cheap. It's got a 0.43 value score, so it's a bit much cheaper than average. It's middle of the road for quality, and it's got a much better growth potential and growth forecast than the rest of the market, which means it is at the moment our second favorite stock. What's important though to look at when you look at this slide is that there are as many material stocks in the bottom half, so Harmony Gold and Northern Platts, that we don't like as they are in the upper half of stocks we like. So it's not as if we build a portfolio that is purely consisting of material stocks or financials. We meticulously manage the risk in the portfolio so that we pick the best stocks with the best risk dimensions, and we manage all the other risks in the portfolio. Impala Platinum, it's certainly quite cheap at the moment. However, its quality is rather average, and we find that its growth dimension, its growth forecast is rather weak. It's sitting at the bottom of the pack in terms of our holistic alpha score or multi-factor slice. And you'll see it has actually deteriorated quite significantly over the last couple of months, where it used to be one of our favorite stocks, and it has come down significantly. So that speaks to the activeness of the portfolio and the ability to change the perception and the perspective on any given stock in the portfolio as new information comes to bear. Now, the important question on how to combine this Stand-Up Enhanced Multi-Style Fund with other funds. What's important to keep in mind here is that this really is almost an all-weather fund. So where traditional discretionary fund managers typically invest according to a specific style, so a value manager or a quality manager or a growth manager, what that does is it makes it hard to determine when do you allocate to value, when do you allocate to quality, and when do you allocate to growth. And by building this holistic portfolio that is better than the benchmark in all three dimensions simultaneously, what we do is we ensure that there's always a piston firing. There's always a style or a stock or a portion of the portfolio that is performing well, meaning that we are able to generate a rather persistent alpha stream through the cycle. Of course, it's not a crystal ball, and there will be periods when the fund underperforms. But we find that typically those periods of underperformance is when the market becomes irrational. And when the market is irrational, I guess you can expect a rational fund such as this to underperform. To position the performance of the fund over the last 5 years, the fund has got a 6-year track record. The fund was started at Fairtree, came over to Stand-up at the end of 2019. It's now got a 6-year track record. Morningstar only does a 5-year number in their reports, but on the 5-year rolling number, the fund is top quartile in terms of performance, and as importantly, almost bottom decile in terms of fees. Please do your own analysis, but I think you'll find the alpha correlation of the fund is such that it would add value when combined to an existing set of active managers because of the largely negative alpha correlation. So I guess in conclusion, we could reiterate the question: if you could get an active equity fund with no style bias, top quartile performance, and at a fraction of the cost, would you buy it? When the process is transparent and well articulated, the performance is persistent and with low correlation to competitors, that provides you with a cost-effective bottom-up stock-picking active portfolio and an established long-term track record, would you buy it? So thank you very much for your time and attention. It's much appreciated. I'm going to hand back to Kyle to help us address a couple of questions.
Thanks, Rademeyer and Vanessa. That was great. I've got a couple of questions that I will address to both of you, and then whoever wants to take it can just put up their hand and go ahead. So I think the first one comes across from Emil, and he's just asked, sort of, in terms of scores for each share, you look at quality, growth, and value. How do you think about other factors such as momentum, for example, and why were these 3 factors selected?
So I can take that one. So within our scoring methodology, we've got the 3 core investment styles. But within those 3 core investment styles, we've got factors. So for instance, from the growth perspective, we would have a factor such as momentum, which would have its own metrics. So to answer your question, we do consider various other factors, but those are embedded within the investment styles. And more specifically, from a momentum perspective, we'd be looking at the recent earnings and how those have been performing. Do you want to add something, Rademeyer?
No, 100%. Thanks, Vanessa.
Okay, cool.
Thanks, Vanessa. Then just one from Anonymous here. How active is the fund? What is the fund's active share? And maybe just to add to that, you could just sort of reiterate, how many top 10 overlaps do you have with the benchmark that you guys use?
Okay, so I'd like to take that one. So in terms of active share, the fund is pretty different from the benchmark. In fact, from a numbers perspective, our active share is between 40 to 50%. And just by looking at the top 10, we actually only have 4 constituents within the Stand-up Enhanced multi-style equity fund that are the same as the benchmark. And these include Sibanye, Anglo, Capitec, and Prosperous. And this just highlights the high active share component of the fund.
Brilliant, thanks. And then one from Michael here. How are you varying your views on macro risks over time? Is there times you want oil or rand exposure?
Yeah, Carl, that's a very insightful question. So I think what's important about this fund is that it is a bottom-up stock picking process. It's not a top-down macro forecasting process. And what that means is that we don't particularly have a view on what the gold price is going to do or what the oil price is going to do. And the way we manage that risk is to have the same macroeconomic exposure as the benchmark to those risks. So the benchmark is 50% in oil stocks. Then there's a certain oil driver, macro oil driver in the benchmark that drives returns, and we want to match that. So if the oil price goes up 50% and the portfolio goes up as a result of that by 20%, we want to go up by 20% because of that return driver as well. So we neutralize the macroeconomic exposure of the portfolio, whilst underlying, we maximize the quality, value, and growth dimensions And that is the packet that we deliver to clients.
Thanks, Rademeyer. Well answered. Just quickly, one from Louis. He's just asked, how did the fund perform in March 2020 during the COVID crisis? And maybe you could also comment on whether it's tough to stick to your process during that type of significant event where the markets react so quickly.
Yeah, so I think there was certainly, as I've mentioned in the presentation, when the market is irrational, it is to be expected that a rational fund will have periods of underperformance. And so in March 2020, the fund had a couple of days of severe underperformance, and that subsequently was recovered to result in a marginally down month. And the fund is, as you saw, generated significant alpha year to date and on a 1 year and 2 year basis. So I think what that speaks to is the incredible importance of being able to stick to your process through the bad times and the good times. And that is the unemotional, unbiased approach to active fund management that this fund brings to the market. For me as a person and for our team, of course, emotionally, it's very difficult when there are periods of underperformance. We feel the pain, but we don't act on those feelings. We stick to the process through good times and through bad times, and it has certainly done us in good stead.
Thanks, Rademeyer. We've got another one here from Michael. He's just asked here, does the fund outperform its benchmarks more when the market is doing well or when the market is declining? I guess in a bull or bear market, how can he position his fund within a portfolio if he's putting a portfolio together for a client?
So Michael, that's a very good question. So what that really speaks to is what is the market beta of the fund? And you'll find that some competitor funds have got a very low market beta, so a very defensive portfolio, very low exposure to the market beta. And what happens typically in those scenarios is that when the market is in a bull market, the fund typically lags a little bit. And then when there's a strong bear market, the fund outperforms. That's indicative of a low market beta fund. What we do is we try to have the market beta 1. So we want to give you exactly the same market returns as the benchmark and then add alpha on top of that. So it's one of the constraints that we put in the optimizer is we say, give us a portfolio that is maximum alpha, minimum risk, max 5% active single stock risk, and beta of 1. And we've certainly managed to achieve that in all the analytics that we run on the fund. The market beta is basically 1.001. So a very aware risk that we manage to give you a beta of 1.
Brilliant. Another question here we've got from Anonymous. It's how are your days spent relative to a traditional active manager who, for instance, may see corporate management teams on days within a month? You guys obviously aren't seeing management teams. Maybe you got your time is spent doing something else. Maybe if you can just elaborate on where most of your time is spent during the day.
So us as a team are constantly working on ways to improve our alpha signals and our risk management. To put that in context, you can think of it as running a factory. So we are constantly working on improving this alpha factory. Something comes in, the stocks and the fundamentals from the balance sheet and the income statement, and on the other side comes out a portfolio. We never tinker with what comes out of the portfolio, out of the factory. That is what we implement. But we're constantly working on making the factory more efficient. So we are doing research. We are publishing academic papers on that. We are employing and researching and trying different ways of looking at the market. We are looking at employing machine learning, different ways of determining and disentangling the return drivers of the market. So very much research is in our day-to-day.
Brilliant, thank you. So if a share scores highly on your various metrics and it comes up as something you like, sort of what's your process in terms of building that position, whether it be overweight or I guess vice versa, whether it sort of starts scoring negatively and you want to underweight that position?
So if I understand the question correctly, it really speaks to how we build the position up over time, or how we unwind the position if we like or dislike the stock.
100%, yeah, that's it.
Okay. So the risk that you have in any type of active fund management of falling in love with the stock immediately is that you trade to maximum capacity immediately, resulting in significant turnover and additional trading costs in the fund. So what we do is we fall in love gradually. We evaluate a stock on a 12-monthly basis, and we build up our position. If we like a stock for 12 months in a row, we would build up our active weight over time. If halfway through the building up process, we start disliking the stock, we would start unwinding that process. So what that does is it really gives us that smooth allocation of capital into high alpha generating positions, and it gradually unwinds positions where we start to have a negative view. It reduces the transaction costs in the portfolio, but it ensures that we are always taking new information and new stock information into account.
Thanks, Rademeyer. Another question here from Vanessa. How do you prevent over or under diversification in this fund? So I guess I talked a little bit to our risk management process.
Over diversification or under diversification. So I guess over diversification is basically the benchmark. So you've got no risk, and under diversification is if you hold one stock. So we don't specify to our optimization what the target number of stocks is. And I think that's an important point, because the optimal allocation between on the seesaw of risk and return is determined by this multi-dimensional array of information on the quality, value, and growth dimensions for every stock, and the macroeconomic, market beta, sector, and correlation dimension. So it's a truly multi-dimensional evaluation to arrive at the optimal stock position. And we believe that that is the perfectly diversified portfolio.
Thanks, Rademeyer. A question from Sean. What is your turnover rate in the portfolio, and hence how do you manage your fund costs?
So turnover is about 100% per year, two-way turnover. That's important. So it's not one way, it's two-way, and that is in line with an active manager that makes use of a discretionary process. And that is important to help us manage our transaction costs. So we are very cognizant of transaction costs and efficiency in our implementation. And I think that that's where our core DNA as an index tracking business and on top of the alpha process really comes into play. So the implementation of our portfolios are absolutely best in class. Then we are absolutely meticulous in our risk management, and we are absolutely meticulous in terms of our alpha signal evaluation and optimization.
Okay, I see Sean's just had a follow-up as well. I think so, he's just asked, do you have an optimal strategic global exposure, or how do you manage the currency risk? You can just go through that.
Sure. So this is a 100% SA equity fund. So we don't have any offshore exposure on this. We believe that we are providing you with a building block that gives you SA market beta with alpha on top. We are busy performing research to potentially roll out the process on a global scale, which would then give advisors and users the building blocks with which to allocate capital and manage their strategic level exposures. But bottom line is this is a 100% South African equity fund.
Terrific. Then another one just from Anonymous here is just with regards to the correlation slide you put up that showed the correlation of alpha between the different fund managers. Do you think the low correlation is due to us perhaps not having a style bias within the fund, and the other funds having quite a high style bias, which perhaps makes them a little bit more volatile in terms of their alpha profile?
Absolutely. 100%.
Perfect. Okay, I've just got It looks like another one here from Michael. Got time for one or two more. He says, I noticed that Naspers had a negative ROE. I presume this is due to the market price of 10 cents. Does it make sense to include the changes in the market value of listed investments for calculating the ROE for an investment company holding listed investments like Naspers?
Yeah, I think that's a very relevant and topical question, which is why we do not only look at a single dimension when we construct this holistic quality perspective on the company. So ROE is but one of our inputs under the hood for quality, as Vanessa mentioned earlier, with momentum being under the growth hood. ROE is one of the drivers for the quality dimension. So what that does is it diversifies away this style-specific or signal-specific risk that you have, as highlighted by Michael in the question. So we really give this diversified exposure across styles, across information signals, and across risks.
Thanks, Rademeyer. Sorry, I'm just checking out for there's a few questions that have come through.
So I see there's a question from Tutuko on the published research papers.
Yes.
So let me maybe field that one. So I've recently written a paper with Emlyn Flint that is currently available. Man, I have blue screen on the name of the website. But the theme of the paper is the global study on factor information decay. So if you Google that, you'll find the paper. And what we've done in this paper is to perform a global study on what is the optimal holding period for any given style that active managers typically use. So value is typically a style that takes a very long time to pay off. And that's why deep value is an acknowledged investment style. So if you buy a portfolio that is only cheap stocks, it takes like 3 years for you to generate the alpha from that investment style. If, however, you look at momentum as an investment style, you need to trade that quite frequently. So the holding period for momentum as an investment style is between 6 months and 9 months before the information or the alpha in the signal is dissipated. And then for quality is somewhere in between value and momentum in the sort of 1.5 year region. And we've done this fascinating piece of work on a global basis where we evaluate not only the SA market, but we look at 24 different global markets from across the board and across the industry to ascertain what is the optimal holding period for each of these different individual investment styles. And the read-through on that is if you are able to evaluate what is the optimal holding period for the alpha to pay off, you can determine what is the optimal rebalance frequency. And that really speaks to the question, I think it was that Sean asked about turnover. If you know what is your optimal holding period for your alpha signal to generate the alpha, you can minimize your turnover and only trade at that window. And that's why we've got that 12-month holding period for this multidimensional, holistic quality, value, and growth portfolio. I hope that makes sense.
Thanks, Rademeyer. Yeah, I think I see another one here from Singer. And I think it's maybe just a reiteration, but is the stock selection of the portfolio based on the quantitative ranking of metrics such as growth, quality, and value? Will that be the starting point? And if so, the portfolio is style agnostic, am I right? So I guess it's just talking to that initial scoring, how that happens per stock, and then I guess if there's that risk overlay post that.
Sorry, Carl, can you just repeat the question, please?
Sure. So it's just asking, is the stock selection of the portfolio based on the quantitative ranking of metrics such as growth, value, and quality? Will it be the starting point? And if so, this portfolio is style agnostic if he's right.
Yeah, that's 100% right. Yeah, That's exactly. But I think perhaps to just point out, excuse me, a slight nuance is that it is not purely ranked by styles, because ranking is a very crude way of determining the nuance of the stock. It is scored in a very sophisticated way to arrive at that number between -3 and 3. If you rank, you just end up with a stock with a number between 1 to 140. That is, you lose a lot of the information density and the information nuance if you rank. So conceptually, yes, that is why we style neutral, but it's certainly not ranking. It is much more sophisticated than a simple ranking process.
Okay, brilliant. I've just seen a good question come through from Anonymous here. There is sometimes a perception amongst investors and advisors that systematic means passive. Is this a fund that can go head to head with other large fundamental active funds in the market? And how do we break this perception out there in the market?
Yeah, so it is certainly not a passive fund. I think it's important to highlight what passive means is it means it tracks an index. Active is anything that takes an active position relative to the index. So the fund is very active, and we have designed it to go toe-to-toe with any discretionary active manager. How do we break that perception? By outperforming the benchmark and by ensuring that we get our messaging spot on when we talk about the Stand-Up Enhanced Multi-Style Equity Fund. And hopefully we're starting to get that point across, that this is a very active, alpha-generating active fund.
Thanks, Rademeyer. And then from Spalding, do you overweight a particular factor or style? And given the current share selected and weighting per share, what is the proportion per style?
Yeah, thank you, Spalding. So it's a very insightful question. So we start off with an equal weighting across the 3 style factors. And then periodically we do a statistical analysis to determine the significance of every one of those 3. And we would then slightly tweak depending on where the market environment currently is, away from the SAA, the strategic asset allocation of equally weighted, to a slightly TAA or tactical asset allocation on the weights. And we are at the moment slightly overweight to value. And it has certainly done us in good stead as well.
Thanks, Rademeyer. Maybe a good follow-up to that one. It said here, it's argued that the SA market is too small, declining, and concentrated to recognize style facts clearly. Can you comment on that?
I think the only rebuttal to that is if the market is too small or concentrated for style investing, it is too concentrated or too small for any type of active investing. And I think, again, the performance is indicative of the fact that style investing and multi-style investing works very well in the SA market. It is active management after all.
Brilliant. I see there's also a comment here just saying that they would hate to play poker against Rademeyer. So you obviously got a bit of a poker face on. Yeah. So I think, guys, that's all the questions. We'd just like to thank you very much for attending today's webinar. We really appreciate your time and support. And we hope the webinar has been of interest. We will send through the slide pack and it will be available. Plus you'll get your CPD points in a follow-up mailer. But if you do have any questions, please contact your relevant BDM or send us the mail through to Stanley and we'll revert back. Thanks, Rademeyer and Vanessa. And everyone have a great day further. Cheers and take care.